All right, testing. Let's see if we're streaming. Nothing to win and nothing left to lose. No, are we not streaming? There we're streaming. Aha! Ha ha! Good morning, everybody. How you doing? Comment allez-vous? Right, testing. Ho, Trade Non-Farm Payrolls live. It's a Friday, best day of the week. Not the first Friday of the month, though. What's going on? Would you like a do-si-do for breakfast? You like Girl Scout cookies? Ooh, Thin Mint. All right, I forgot I had those. I got grapes. I got my banana. I got my, banana. I got my apple. I think we're good to go. So anyways, welcome to Trade Non-Farm Payrolls Live 143. Is that cool? So good morning. All right, Trade Non-Farm Payrolls 143. What does that mean? Well, that means next month is the 12-year anniversary of this webinar. 12 years. I bet you most people haven't even traded Forex for 12 years. I bet you the last guru, the last guru you've spoken to probably hasn't traded Forex for 12 years. So anyways, got my Harvard colors on. Hope you appreciate that. Got my Harvard shoes on. Huh? Pretty fly for a white guy. So anyways, I'm super excited. Thank you to FX Street for hosting. Namaste. My name is Wayne McDonell. I am the Chief FX Market Strategist for TradersWay.com. We're a boutique brokerage firm. We specialize in things like world-class customer service and treating you with respect and dignity, providing fast execution speeds. Yeah. And every single day, I work with Traders Way clients, do free webinars and training and such. So you have someone on your team, and we want you to survive, and then we want you to thrive as a currency trader. So one day you'll feel confident in your skills and ability to trade profitably, and one day you'll open a live account, trade real money, and slowly but surely, over years and years and years, you'll grow your account size, grow your lot size, and we'll be the prime broker for your successful Forex trading business. And we're willing to invest in you up front, even if it takes years for you to get there. We're here for you every single day. How does that sound? Good shoes, FX Street. FX Street moderators like, good shoes. Yeah, I actually had an African-American woman approach me on the street one day and say, you're pretty fly for a white guy. She didn't say it in words, but it was pretty funny. It was a really funny moment. So anyways, good to see you. We're watching the chat here on the YouTube, which is really nice, much easier. What type of breakfast goes with a cigar? In fact, coffee and cigars are great. Chocolate cookies and cigars and coffee would be, I don't know, like, blow your mind. So anyways, non-farm payrolls. Last month was quite volatile because we got a surprise on wages. If you talk to experts, it may not be the right type of wages, might be temporary wages. And here's something interesting that I'm kind of excited about. As you may know, I'm in grad school at Harvard, which is giving me access to really cool things like reading the first edition of Adam Smith's Wealth of Nations, you know, stuff like that. which is just like, wow, that's crazy if you're an economist. But I'm also in an advanced macroeconomics class at Harvard taught by a senior economist at the Boston Fed. Not bad. And I just spent 2 weekends ago, I spent the entire weekend, Friday night, all day Saturday, and all day Sunday morning, debating the minimum wage with someone who not only worked at the Boston Fed, but also the New York Fed. So, you know, as an economist, like hanging out with the Fed, so to speak, is super exciting. But, you know, we didn't hang out at the Fed. That would have been like ridiculous. Like, let's go to the Fed and hang out in a boardroom or something. No, it was only Harvard Hall, built in 1680 or something. Yeah, 1680. 200 years before the Civil War is when the building was built on Harvard. Yes, and which is awesome because you get there and there are like tourists taking pictures of this beautiful old building. It's so old. It's hundreds and hundreds and hundreds and hundreds of years old, right? And they're like, look at this, and they're taking pictures. I'm like, excuse me. I walk past and I open the front door and go in, which is just an amazing honor. But then you get inside and it's all modern. Yeah, totally modern inside. You're like, wow. Maybe even a little disappointing. You're like, too modern. You're like, really? But wild if you think about it. The building across from it is Massachusetts Hall, and George Washington spent the night in that hall. Across the street is where George Washington gathered all his troops before attacking the British in Boston. You know, like, it's a pretty neat place. But anyways, I digress. So macroeconomics, huh? Doing a little non-farm payrolls. We're looking at wages. We're looking at numbers of jobs. But as I explained before, if you attended last non-farm payrolls, we took a look at things like those employed, those are not employed, those that are not in the workforce. And we were looking at the changes in these things because you get to a point where everyone that is looking for a job will get a job. And then there are those that have given up looking for work maybe over the last few years, but now the jobs are so good that it starts to attract them back to the market. And when you get to that, they move from not in labor force, otherwise known as N, right? There's the employed, right? There's E, there's U, and there's N, and they should all add up. So in this case, we want to see not in the workforce. They don't have a job and they're not looking for a job. So after a while, they just don't get counted. And we saw the unemployment rate fall for quite a bit of the fall in the unemployment rate. Actually had to do with people just stop looking for jobs, right? So now it's interesting where if things are good, the unemployment rate might actually rise, but that would be a good thing because we get people moving from N, not in the workforce, to suddenly in the workforce, right? Which would then change that employed number or unemployed number. So you might actually see more people unemployed, but all that means is they're now looking for jobs, and there are so many jobs out there, right? So that's interesting. And does anybody know the COLA model? Probably not. It's an obscure thing that the Fed dudes watch. And what it does is it shows the number of people unemployed, and it shows the number of jobs being advertised, and it looks at sort of the trends, right? And it'll show, basically what it shows is the type of jobs available and the type of people available for those jobs. That looks at the U, right? The unemployed. So it's looking at the relationship between the unemployed and the work available. And for like decades and decades and decades, they kind of moved together. And when the economy went down, the number of jobs would go down and the unemployment rate would go up. But then you could see a relationship. And then when the economy started to improve, the job wanted job opportunity ads would suddenly hit the newspaper. I mean, it's that old, right? It would go to the newspaper. Now, obviously, tracks things like monster.com or whatever people use to get a job. But anyways, you can see this relationship. Then the economy would improve, and the number of jobs would go up, and then people looking for those jobs, and then there'd be a match, and the unemployment rate would fall, and it was good. The interesting thing since the 2008 crisis and the improvement in the economy, we're starting to see something very interesting that the Fed is very, kind of scratching their head on. The jobs that are open don't match with the available workforce. So the dudes looking for work don't have the skills to perform the work. And that's bad, right? Oh, how did the debate go for the minimum wage? There was a very funny moment. Very, very funny moment. We watched a 1-hour documentary. Now, bear in mind, I'm in Harvard Yard at Harvard University, right? We watched a 1-hour documentary about regular people. And I'm not joking. Regular people, like that work at the minimum wage. What is their life like? We watched a 1-hour documentary, and all it was about this woman in Tennessee. She's a nurse. She got married young, and during the marriage, they had 3 beautiful children. And then turns out the man she married is an idiot. And so then they go through a divorce or separation, and he doesn't have any money, and he doesn't have a place to live, so he has to go somewhere else in Tennessee, and he lives there, and she lives in a trailer, and she works like 90 hours a day and makes just over minimum wage, and taking care of 3 kids. Guess what? It's very difficult, and she's got to go here and got to go there, and she needs assistant, and she needs to do this, and she needs to do that, and then she comes home and she hasn't slept in days, and kids are a mess, and the trailer is a mess, but for some reason she has 3 cats and a dog, and the dog's pissed everywhere, and now she's got to clean that, and she's got no friends and no life, and her husband's not contributing, and I'm like, oh my God. So we watch a whole hour of this, and then we're done. So now, as good Harvard people, now we've been informed what it's like to be a normal person. And so the next day I told the professor, I'm like, you realize that's really funny, right? That we're such elitists in this university that we have to watch a documentary about regular people and then, debate about it. So how did it go? It was funny. But I enjoyed the people and the case studies. Anyways, wicked smart people at Harvard. Like, one person was an attorney who works for a car company doing artificial intelligence. And like, really? What? Lots of accountants and stuff like that. It was just, anyways. So I learned about regular people. Okay? Now, the thing about these events is I don't consider you regular. You can't possibly be regular. I think in my book, which I now was published 10 years ago, which means I wrote it about 10, 12 years ago, right? Anyways, I think when I open up that book, I say, look, if you stood on the corner of a busy intersection in a big city, and you say, hey, I have an opportunity for you to get involved with. There's about a 95% chance you'll lose money. You want to, what do you think? You want to get in? You want to get in? Do you want to get in on this opportunity? And the funny thing is, we're all here, right? And I've been an entrepreneur my whole life, and you probably have been too, but there's something horribly wrong with us. Because you say, okay, that sounds good. I'm interested in Forex. Yes, 95% of amateur traders lose their money. Great, sign me up. Where do I get going? Because I ain't regular. I ain't regular people, right? People is stupid is my new t-shirt. Right? Yeah, Brendan Murphy, regular people. Ugh. So we're irregular. But I think that's a good thing. All right, so you understand that we see this challenge. A sane person. I'm not saying you're not intelligent. I'm just saying you're crazy. Because a sane person would say 95% chance of losing money or 95% chance of failure. I would pass on that, right? Like that would be logical, right? And yet here we are, all of us. So we accept risk for some reason. We see past this risk and we only see the opportunity, right? Right. Well, Josh says no one got rich working 9 to 5. No, especially not at minimum wage, right? First of all, if you do have a job that's guaranteed, right, which is the opposite of currency trading, because you can work all day currency trading and lose money for the opportunity, right? So if you want guaranteed income, aka a job, by definition, you have guaranteed poverty. That's how I look at it. So, but nonetheless, we accept this risk because of whatever it is. We either want the opportunity, we can afford the opportunity. Maybe we just can't have a regular job. Maybe we're broken. I don't know. But we see past that. But entrepreneurs do see past that too, right? I've started many businesses and I was a venture capitalist. And before that, I worked with angel investors and all that kind of stuff, right? So to me, when you say 95% failure, well, I feel like I can walk into a room and win 95% of the time, like easy, because 95% of people are easy to beat, right? Then I put it into different contexts and say, well, if I borrowed several $1 million, bought an old restaurant that's gone out of business, refurnished the whole thing, updated the kitchen, printed a whole bunch of menus, hired and trained a whole bunch of staff, bought a ton of food, and then advertised and then sat there waiting. I hope people show up to my beautiful restaurant. We're all here. I got 5 waitresses. I got 2 chefs and 3 preppers and a dishwasher and a kitchen hand. And I got my suit and tie on. I hope somebody shows up, right? And how many new restaurants fail? Well, first of all, you just dumped a couple of million into this place, and you got to have, what, at least a year's worth of cash available so that you can survive the first year when you're still building clientele and getting repeat business. I'm like, the failure rate of restaurants must be very similar to the failure rate of amateur Forex traders, right? Except you probably don't put $2 million into your trading account to begin with. So I look at Forex, I'm like, well, first of all, I can beat normal any day because I'm abnormal. I can beat normal every day. You have to have some level of confidence, right? And then I don't have to put $2 million up front to get going, to learn the ropes and have this business. But then Forex as a business has no cash receivables, no cash payables. You get instant gratification. Did you make money on the trade? Yes or no? Yeah. In fact, you can be profitable in a profitable trade and you're already getting paid and you haven't even cashed out of the trade. Now, if you buy stock, you buy Apple and it goes up $100 a share, how much of that is in your account before you take profit? None. Zero. Zip. Are they paying you interest rate? No. Right? Maybe you get a dividend. I even doubt that, right? But in Forex, you mark to the market and all that kind of stuff, so you haven't even cashed out. So what I'm trying to say is if you bought a stock and it goes up $100, you don't get the $100 until you sell the stock. But what if the stock goes up another $100? Well, you got out and now you're not in anymore. Well, in Forex, you're getting paid as you hold the trade. In stocks, you don't get paid while you hold. You buy low and you sell high and then you're out. Well, in Forex, you buy, you get paid as you're holding it. You can still get paid as you're holding it. You're collecting interest at the end of the day. I mean, oh my gosh, it's such a great business. I have literally reviewed thousands of business plans. When I was a venture capitalist, made exactly, in fact, 100 investments. I've helped other companies raise millions of dollars for themselves. And guess what? Forex is by far the best. And I've been doing this now since the euro was below parity with the US dollar. I remember the day the euro went above $1. And I'm still here, still alive and kicking. This is what, 143rd month of just this one webinar. I've been doing webinars at FX Street even longer than that. So I'm telling you, it's worth the effort, but there's something wrong with us. The entrepreneurial side says we are not risk averse, that we accept risk. And that's what we need to deal with and grapple with as currency traders. So as you learn technical analysis, as you learn fundamental analysis, what you're going to have to do is also how to learn how to manage risk, because you get here maybe because you want the reward, and reward is function of risk, and therefore you take on risk, and risk will kill you. Well, it won't kill you. It'll kill your trading account, and maybe you jump off a bridge. And jumping off the bridge would kill you, but it wouldn't be, it'd be, what? It wouldn't be causation, it'd be correlation, whatever, right? So anyways, risk is bad. So let me remind you that trading is risky, not appropriate for everyone. Your performance, good or bad, is not necessarily indicative of future results. So please stay small, stay humble, focus on the long term, and never risk money you cannot afford to lose. And once again, my name is Wayne McDonell. I'm the Chief FX Market Strategist for Traders Way. Welcome to the webinar. 143rd month in a row of doing this one particular webinar. Excellent. And I would highly encourage you to visit tradersway.com and at least open a demo account so you can test us out, test out the execution speed. It's faster than most. You'll find that. That was tested by a third party. Check it out. Customer service is great. And you get to work with me every day, just like this in webinars. Every single day I work with you for free, which I hope is a good deal. My particular point of view of trading, as I'm getting to, has to do with surviving. Okay? Capital preservation means money is your product, money is your service. So think of Forex as a business. You lose money, you're out. Imagine you're in the shoe business and you don't have any shoes. You're not going to be successful, right? So the number one goal before you even pull the trigger is maybe before you pull the trigger, think about it. Okay? Live to trade another day. Once you've analyzed whether the risk and reward ratio is fine and all this kind of stuff, then you want to make sure that you get compensated for the risk you take. You got to get paid for the risk. So I said early on something called a minimal acceptable performance. And what that means is I have to make at least a certain number of pips, bare minimum, to consider it even, maybe even moderately successful. Right? Your goal shouldn't be to break even. Hey, I'm going to break even on this trade. Woohoo! Right? And think about it. You're not going to be 100% successful. You're going to have losing trades too, right? So these minimal acceptable performance trades, the idea is you shouldn't aim for your minimal acceptable performance, but it should be the bare minimum. For example, if you see a trade and it's worth 50 pips in your mind, you look at it and you say, well, if I buy it here and I take profit there, that's about 50 pips. At some point, when you move your stop to lock in profit, it needs to be some portion of that 50 pip potential. Okay? Meaning, I have, or had, I don't necessarily trade this way anymore. It certainly got me through the first 5 or 6 or 7 years, right? Where I should be shocked if I can't lock in 15 pips, 1-5. Okay? If I move my stop to protect those 15 pips and it came back and knocked me out, I'd be bitterly disappointed. I would say, oh my gosh, I got knocked out. Well, at least I got my MAP, minimal acceptable performance. But the goal should be 50. And what it does is it goes back to the capital preservation thing, where if I look at my trade setup, let's say it's a 15-minute chart, I have a higher high, so I'm setting up a higher low, it's retracing back into my Fibonacci area, and I want to buy it, so then I look and say, well, if it bounces at this 382, it's going to go to a 1618. I measure that out, and I see it's 63 pips, and I say, yeah, that's worth it for me. I think my strategy or my plan is to buy around that 382, and it's going to go to the 1618. That's easily 60 pips. Worth it. Okay? If I did the same thing and there was only 30 pips into it, I may say, you know what, I'm just going to preserve my capital. Because it's not enough, let's say. Right? If you're doing a spot trade, that's a pretty mediocre spot trade. I mean, you should be able to scalp 30 pips, right? So a spot trade, and certainly not a swing trade, right? So at some point you say, you know what, it's not worth it, so I'll skip it. Or it's easily worth it, and you know, and on a 60 pip trade plan, wouldn't you be dumbfounded that you didn't even make a lousy 15 pips? You know, so when you're up like, let's say 30 or 40 pips and it's really starting to take off, yeah, lock in that small profit. No, but the thing is, you'll never get filthy stinking rich at 15 pips at a time, right? You need those 60 pip winners. In fact, you need more than 60 pips on a lot of these trades. So what I find is the map ends up paying for the losers. So you should have more sort of, because minimal acceptable performance to me is almost like a break-even trade adjusted for the risk. It's sort of like real versus nominal rates. A real rate is adjusted for inflation. So, you know, like 15 pip profit is really break-even if you look at the risk you took, right? You see what I mean? Because what happens is you should have more break-even or map trades than you have losing trades, but essentially your minimal acceptable performance trades, you know, are paying for your losers. So you might have, you know, maybe your average loser is 45 pips, and your average minimal acceptable performance trade obviously is going to be 15. So you're going to need 3 times more of those break-evens, which you probably should have, compared to your bigger losses. But you don't want small trades. You don't want to die of 1,000 lashes, right? So you don't want to have 15 pip losers. You're better off having 50 pip losers. But anyway, so going all that together, what does that mean? Your little winners are going to pay for your moderate losers. You're not allowed to have big losers, by the way. So your moderate winners are going to pay for your losers. Okay? So what's left over? When you have a good trade, you've removed your risk by moving your stop. Yeah, I just noticed this thing changed. I updated that. It says 142. It should be 143. I'll change it later. So your minimal acceptable performance trades, the ones that don't get knocked out at break even, so you move the lock-in map, that's when you allow those winners to run. So you get your 60 pips, but in other situations like swing trades, you should really be knocking down 200 or 300 pips. I'm going to kill my Skype. What's going on, Skype? I'm not even running Skype. Gee whiz, huh? Microsoft sucks. Anyways. So that's where you're going to make the vast majority of your pips. You need to look beyond a 15-minute chart. You need to look beyond 25 pip winners. And at some point, you're going to need to let these things run. And that's going to be the difference. So there are times in the year where you should have 5 or 6 or 7 trades open with 1 to 2 or 300 pips each. Oh, Willie joined Trader's Way? Right on, man. Cool. So you see what I mean? And so we got to get you to that level. Well, how do you get yourself into trades that are beyond, let's say, the 25 and 30 and even 50 pip winners? How do you get to 1 and 2 and 300 pip winners? That's where long-term technical bias and fundamental analysis comes in. Okay? We got to get you away from like 1 and 200 pip months to 1 or 2,000 pip months. Okay? But that means you need to be beyond that 15-minute chart, doesn't it? Mikhail opened a Trader's Way account? Cool. Right on. Hey Kenny. How many people have attended my daily webinar stuff? And is it true that we put together trade plans that pulled out a minimum 1,000 pips? How about this? Instead of yes, I think everyone's going to say yes. Just to confirm, we've put together trade plans, let's say 2 or 3 months in a row, that easily yielded a minimum of 1,000 pips. Type in 1,000. So it's not just yep and yes. Actually type in 1,000 if you can confirm that we've done this together, not just once or 2 in a row, but like 2, 3 months in a row, over and over and over again. Actually type in 1,000. 1,000. Now, it looks like dozens of people have said yes. So let's see if we can flip them over. Now type in 1,000. Okay, 1,000, 1,000, 1,000. Yeah. Okay? Which means we have to get you to that point where you need to combine the capital preservation, the capital acquisition, and the capital appreciation. And you got to get to the mindset where 25 pip winners are really just paying off your 50 pip losers. And that's not where you're going to make the majority of your income at the end of the year. The majority of your income at the end of the year is getting the market right. Not just the price volatility, the market right. So that you can get these trades in, let them run with your stop already protecting small winners, but letting them run. Because there's nothing worse than taking a 25 pip profit on a 250 pip move. And I think a lot of traders that have been around 2 or 3 years and haven't found profit yet are in that situation where they're doing everything right except letting your winners run. So again, the key here is long-term technical bias and fundamental analysis. And by fundamentals, I don't mean news. I mean macroeconomics, central banking policy. News are just event-driven or events that create volatility, but it's the sum of the whole of all of these news releases and what they mean to a central bank that is in charge of managing that economy and the policies that they carry out. Okay? So it's like, it's not the fact that NFP is jobs, it's what does the NFP mean to the Fed? Okay? If the number comes out good, that may make the policy change in such a way at the Fed that it ends up being bad for the market. So a good number can be bad, but also a good number can be good because it can confirm that what the central bank is doing is helping the economy, and that's good. So it's not the news release, because a number like 250, whatever that is, can make the market go up, it can make the market go down, and it's only because it's the market's perception of what the central bank will do next. So it's more of you should focus more on the central bank than the individual jobs report. So anyways, you're going to need to know some fundamental analysis. Okay. So anyways, thank you everyone to confirming it's almost, I mean, it is required that you let your winners run. You know, I have to change this thing floating and saying the wrong number. I changed it, but it must have not saved. March 9th, when, you know what, I know what happened. So let's see. Let's see if it changes. So the next round, I think it'll say 143. That's right. All right. Yen pairs all the way up. And yeah, so what we did is, again, this is for Traders Way clients. We do daily webinars. In like November, December, all the yen pairs went up, but we had set that up weeks and weeks and weeks in advance. But we also knew I timed it to a particular day, weeks in advance, that we would take profit on all those yen longs and then sell all the yen pairs, and that would last to about now, really, you know, to about April, but we're in this 6-week window now. But anyways, we knew that it would fall not just for a day or a week or a month, but 3 or 4 months. And so we've been shorting the yen pairs since January. So if you're just on the clue train for that now, you need to attend my daily webinars. So again, go to Traders Way. At least open a demo account. It takes you 30 seconds and you get in the webinars. In the back office, there's a little button that says webinars, and that's me. All right, take a screenshot here. This is my setup. I'm going to quickly go through my technical setup. And we're about 20.5 minutes away from NFP. Okay. So the way I break the market down is I look at the speed of the market, then I look at momentum of price, and then we look at the long-term trend, which probably because of the volatility, it's probably not that important because volatility will respond to the news. It won't respond to the long-term trend. I mean, you could do basically anything, right? We'll look at volatility indicators. We'll look at the oscillators, how I separate market from price. So again, speed of the market, I'll use certain EMAs. And then I look at momentum of price using other EMAs. Okay? Market, price. Then oscillators. I also use 2 oscillators to separate market from price. Now, let's be clear. Right? Why do it this way? I decided a long time ago. So when I first started trading, when you open an account, you didn't even get charts. So even technical analysis was new. And the few professional investors I actually knew laughed at the prospect of technical analysis. Like in my face, laughed at me because technical analysis was so stupid. Okay? So I had to teach myself. There were no books. The only book, Amazon.com was a bookstore. That's how long it was. There was nothing on Amazon.com, so I went to Barnes & Noble, which was a huge, monstrous bookstore. Every neighborhood had one, right? This is how long ago it was. There was one book there called Forex Made Easy, which was stupid. So I actually had to go to the Stanford University bookstore in Palo Alto to get a book on something about trading. I mean, that's how, there was nothing, right? But anyway, so I had to teach myself, and I said, all right, what does it all mean, Basil? And I said, well, the market is going up and down. People ask this all the time. So what are the markets doing? How are the markets today? And I said, well, that's got to be based on some sort of medium to longer term view of the aggregate. Okay? But no one asked you about which stocks went up and down, just the market, right? So, and back in the day, they meant the Dow, right? And were the stock market up or down? Okay. So I said, well, I need some sort of indicator that says over the medium term, the general move, let's say for the day, the general move recently is up or down. I need some way to define it, not opinion. Up or down. I don't look 25s till we get out of here. Right? So anyways, right? Because that helps me. Because then I realized, because I looked at my trade history and I said, well, there are certain situations where I do well, and then there are other situations where I don't do so well. Turned out I did best when I sold in a falling market. Think about that. I did best, according to my trade history, when I sold in a falling market. And I did best when I bought in a rising market. And everything else kind of held back my success, right? And I didn't realize that until I defined what the market was. So that's really important. So if the 21 is below the 55, the market's down. If the 21 is above the 55, the market's up. And if they're kind of somewhere in between, you know, they're flattening, then it's less up or less down, right? But I had now a way to remove opinion, really, and say, well, technically speaking, the market is bullish. So I know from my trade history, I do better looking for buying opportunities. And that's what it ended up looking like. Now, these are 21.55 EMA. This might be a 15-minute chart. Actually, you can see this is an hourly chart. So this is 1 day's worth of trading, but you can see the day before it was already below the 55. So when I woke up in the morning, in fact, when I went to bed the day before, I was already a bear. Okay, this is an hourly, but really, Katrina says, what time frame? When you're setting up your trade plan, it's whatever time frame you're looking at. So, you know, technically this could be bullish on a 4-hour, but bearish on a 15-minute, right? So what does that mean? You're short-term short, but long-term long. And that you can start counting cycles between the two and say, well, it'll take about 2 hours for the bearishness to come out of the 15-minute chart and turn bullish. And it's already bullish on the other 4-hour chart, right? So therefore, I can probably stay short for 15 or 20 or 30 minutes, take my profit, right? So which means maybe I only make 30 or 40 pips. But then when it turns bullish on the 15-minute chart, I know it's already bullish on the 4-hour, so there's no way I'm going to go for 25 pips. I'm going to go for 100 pips because I know it'll be up for longer. You see? So it helps me justify sort of, or qualify, or even quantify the risk I'm taking on the other time frame. Know when to go for 25, know when to go for 100. Okay? But anyways, this is an hourly chart. What I'm trying to get to is the day before was probably bearish too. Okay? And that overnight, I probably laid in bed thinking, I want to sell this, 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 right? And then I wake up in the morning, we start trading, and you know, if these are hourly charts, right? Lots of time goes by, and then whoa! Or maybe, you know, or maybe this is a 15-minute. I can't tell. It doesn't matter. So anyways, to the left, I was already bearish, which means I come to the market thinking I need an opportunity to sell this. I'm not thinking about buying it. I can't buy it because it's technically bearish. So I need a trigger. And that's the 5-8. Now we're only looking at price action. Sell, take profit. Come back to the moving averages, sell, take profit. Okay? Capiche? I know it's amazing. Wow, sell in a falling market, Wayne. But you know what? I'm sure plenty of people here buy in a falling market. And maybe only because they never really defined what the market was. So it ends up being, even though it's simple, it's quite valuable and quite important. This is the 200 EMA, what I call the fair market value, but like I said earlier, probably doesn't come into play when it comes to volatility. This is a measure of volatility. These are Bollinger Bands. When they're wide like this, there's lots of trading. When they're narrow like this, there's very little trading. The other way you can look at this is instead of volatility, you could use it as a volume indicator. Just think like there's lots of trading here volume wise, and then all of a sudden it dries up. So this kind of warns you, if you want to use Bollinger Bands, it kind of warns you that, look, placing trades now would be a pretty dumb idea. Wait for the volatility to increase again. Okay? And then these narrow sections here actually are indications of, even though there's no trading, there's sort of a buildup of interest, that the longer and more narrow these tunnels are, the bigger the breakout will be. I also think that this is just a clock. This is, people are not ready to trade yet. London opens, boom, right? Then some sort of news comes out, dries everything up. This moves sideways until New York opens, and then boom, it takes off again. Okay, but it's just one measure. Okay, and that's what one typical chart looks like. I like to look at multiple time frames. Okay, what I'm looking at here actually is the oscillators. So I slow MACD down, 21.55.8. Slows MACD down, and it shows me overbought and oversold conditions for the market in general. The market. Okay, and oops. And then the stochastic oscillator, I speed up. The settings are 835, and I speed it up. So it tells me overbought and oversold conditions for price. MACD is market, stochastics is price. But again, I adjust the settings so that they tell me something. I think most people use the settings right out of the box. They add MACD and they're like, that's it. Now I use MACD. If you knew what MACD actually did, I mean, I question the settings. I'm like, why would you use those settings? And you might say, well, Wayne, it's a self-fulfilling prophecy. You use them because everyone else uses them. I'm not like everybody else. So I change MACD to tell me the information that I'm looking for. And I don't care about everybody else because they lose 95% of the time. So have at it. What do you have to be? What do you need to get accepted at Harvard? Well, how about this? Thousands of people applied for my, I'm in an elite program. Thousands of people applied. They took 16. It's a 4-year program, right? 7 people have dropped out because it's too hard. And let me tell you something. I'm in this macroeconomics class, and I'm not too proud or too weak, I suppose, to admit that I think I know a lot about macroeconomics. I trade every day. I follow central banking every day. I understand a lot about fundamentals. A lot. I think I'm nearly brilliant. Plus I have an awesome, plus I'm very modest, right? But here's where I'm getting at. So I walk into this class taught by someone that actively works as a senior economist at the Fed. He's going to teach me about macroeconomics. I'm like, this is a dream come true. I go in there and it's kicking my butt. It's crazy difficult. Crazy difficult. It's like calculus, tons of calculus and algebra, and I understand the concepts, but it's so fast paced. It's just every hour is like a data dump. It's just, bah! Holy crap. Right? And I'm getting my butt whooped, right? And I just can't believe it. And the average grade is very, very low in this class because it's so unbelievably challenging. And yet there are kids, right? Because a lot of them are kids, like these Harvard College kids. They're smart, right? And plus they just took calculus last year or whatever, right? And there are kids getting 100%. And I'm getting my butt whooped. And I'm bringing a lot of experience to the table, but holy smokes. What do you need to get in? I don't know if you want into this because this is pain, man. This is pain. I spend a lot of time studying. So anyways, I thought Harvard would be easy. All right, you guys ready to set up the new scalp? Right? Well, we'll start with euro dollar, all right? Robin? Robin says what? Okay. So, okay, new setup. Okay, this is a high volatility event-driven strategy. We are not going to trade before the news. We're not going to dump a trade and hope for the best. We need the market to react. Now, I've published this years ago at FX Street in great detail, how to do this. There are two opportunities. One, the volatility trade. We're going to let it spike or drop, whatever it is. It's going to react. We're going to wait for a pullback, and then we're going to trade in the direction of the initial reaction. That's the first one. The second one is we'll have several minutes to identify longer-term levels of support and resistance above and below the market. The initial volatility will carry us to those key areas, and then we will look for a counter-trend trade. Things like off old support and resistance or key reversal pivots like monthly pivots clustered with weekly pivots. Okay? So, the initial trade. In this case, we're looking at 1 minute charts here, and we're waiting for NFP, and we're waiting for NFP, and then, holy smokes! Up. The first thing we say in the rules of engagement is we're only allowed to buy, but we don't like to buy high, we need to buy low. So a red candle like this is super interesting. So you want to bust out a Fibonacci, and you want to do a couple of things. First, you want to look in the sweet spot, and you also, second, want to look left to the old high. We're hoping the old resistance becomes support. So in this perfect example, I give you an example of an imperfect world where even in that case, it went lower than here. We would have wanted it about 50%. Went a little lower than the sweet spot, but a 786 is not a reversal. It's cautious, but it's not a reversal. And after, after 1, 2, 3 minutes of it holding, some point you want to get on the clue train. You want to buy it somewhere back in here, and you're still back in the sweet spot. Drop your stop below the lowest low, which probably is only 15 or 20 pips away. And then praying is, right? Hope is not a strategy, but praying doesn't hurt. And in this example, if you bought it, let's say on this candle, you'd be in here just above the 50%. And after some time, once you get up here, right? Once you have it, once it sort of re-challenges the front lines here. In my books, since it's a boot camp thing, FX Bootcamp, it uses a military analogy of, charging the line, right? It's better to be a sniper and charge the line from here than using a bayonet, right? But anyways, once you get to the point where your price is back to the line, the initial retracement line, since your stop is here, since your entry is here and your stop is down here, you want to move your stop to break even before you get to this line, because if it's going to collapse on you in reverse, it'll probably do it off that line because price has already proven for this to be important for whatever reason. So it might go up and up and up, get near this line, and then collapse on you, and then start making lower lows, lower. Imagine this going below 148.50, then you're out, right? Well, in this case, I'd rather you get bust out at break even, right? So you need to move your stop from below here to the break even point before you attack the line, so at least you have no risk. You have the opportunity, but you have no risk. And this is the moment of truth. If it hits the line and drops, you're out at break even. If it breaks the line and the trend continues up to the next level of resistance, you get paid. And boom. Okay. You see these charts? I think these exact images are in my book, which was published 10 years ago, which means I took these images about 12 years ago when I was writing the book. And you notice they look the same generally as the charts I use now. Right? Here's my standard setup. There we go. What does that tell you? I still trade using the same technique after, 15 years, 16, 17 years of this. I don't have a cool new strategy to show you or teach you. I don't have something like with a cool, funny, marketable name. I don't have, trade strategy of the week. I've been doing this for way longer than a decade, almost 2 decades, let's say. That's an exaggeration, but, a very, very long time. And my behavior and my analysis and my methods are the same, which means they endure the test of time. And market conditions have changed a million times over that period, right? So we'll use euro dollar, I think. That's where I have it here. I'll get tradethenews.com to hear it live. And we're about 90 seconds away. Let me now put, I want to see monthly pivots on here, so I'm going to change this to monthly pivots. That's funny, I clicked the wrong one. All right, so it's monthly, weekly. Okay, I'm fine with that. We got some key pivots there. Dropping into a 1-minute chart. All right, remember to use stops. If you don't know what you're doing, don't even trade.
Watching hourly earnings closely, expected at 0.2%
and hopefully
2.8% year
hopefully
over year.
you give traders way an opportunity
to tick up 1/10 to 34.4. Let's get
Hopefully you allow traders way the opportunity to earn your business and your loyalty and respect. So visit us at tradersway.com, huh? Open up a demo account today, and I'll see you in the live webinar on Monday. So remember, we're scalping first, looking for retracements, and then we'll look for counter trend trades, let's say 20 minutes from now. After that, I'll open up the mic to questions, and we can spend the next 2 hours talking and eating do-si-dos and
the data in just a few seconds. .1% for unemployment is 1/10 higher than expected. 313,000 for the payrolls, above the 205,000 expectation. Prior vice higher to 239,000 from 200,000. Unemployment at 4.1% is 1/10 higher than expected. Hourly earnings at 0.1% is 1/10 lower than expected. Month-over-month, year-over-year, 2.6%. 2/10 lower than expected, with the back month revised down 1/10 to 2.8%. Weekly hours at 34.5. That's higher than the 34.4 expectation, up from a revised 34.4 prior. Participation rate at 63% is 3/10 higher than expected, and a 3/10 uptick from the prior month. Canada. Net change in employment at 15.4 thousand, below the 21,000 expectation. 5.8% unemployment is 1/10 lower than expected for Canada.
The market hasn't decided what to do. Be careful.
Payroll numbers higher than expected at 313,000, above the 205 expectation.
All right, so we got a 313, but then I think there was a change somewhere that freaked people out the other way. Unemployment rate went up. But I explained this to you earlier. That's probably a good thing. But remember, people is stupid, so they probably don't get it. So there's an overreaction and then a reaction. So I think what happened was they saw the rise in unemployment. That means the Fed can't raise interest rates. And then all of a sudden they saw the 313, and then they're like, well, the Fed can raise interest rates. And so anyways, be careful. Okay? So now, if you're going to scalp it, be very careful. The initial trade idea of the volatility is dead because there isn't a clear thing. There's two things going on and we don't know who's right. So this adds another dynamic of risk into the equation, and I don't know if I feel super comfortable with that. Okay, so I don't know. For example, if you were going to resell it, are you going to sell it here off that fib, or are you going to measure it this way? Like, how do you measure it, right? So I mean, it's up to you. Okay, it's up to you, but there are pivots down here. There's a weekly pivot that someone might buy, and then there are other people that want to sell it up here because of the drop, but then whoever bought it in the beginning might want to buy that back. I mean, careful. So instead, because I'm not trying to coach you into scalping this, right? You need to do whatever you want. Okay. The next thing that we should do is use longer term pivot points. So how many people here use weekly and monthly pivot points? Or how about this? Let's leave it that. How many people here use monthly and or weekly pivot points? Thin mint. Everybody likes thin mints. You know how many Girl Scout cookies I've sold? Spent hours selling. Probably spent 10 hours selling Girl Scout cookies this month. Look at this, see? 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 Listen to Uncle Wayne. Tons of people just lost their shirt. Listen to Uncle Wayne. Think about that. A broker just coached you into not trading that to protect you. Cool. All right, let's go back. Hang on. We want to identify key levels of support and resistance. Okay. This that held up the market is a weekly central pivot point, which means bulls were buying. So, and I don't have a drawing tool, too bad. This area here is a weekly buy. Okay, we knew that. That's where you buy. I'm going to add a little more to this. Okay, you know what else is also amazing? If you buy that, if you find yourself buying today, if I were me, I would hold this. I'd get my stop to break even, and then I'd get my stop to protect MAP, and I would target that price, 124.61. Okay. Cool, right? So my goal today, if I were still a buyer of this pair, I would hold it over the weekend with my stop already at break even, and I would try to let this run for a potential of, these are my cheap glasses, where are my good glasses? Where are my good glasses? From that bottom to that high, just shy of 200 pips, right? 180 something pips. Okay? And you can see, as a bull now, my thought process was that. Okay? Whoever bought here had that planned out. Hey, Dinesh. Salam. No, salam. Namaste. Well, from Iran. When I studied, I took a whole class at Harvard in regards to the oil industry, the entire history of the oil industry. It was very interesting where, Exxon and all the Western world oil companies went into the Middle East and met with all the Bedouin tribes and stuff that were sitting on top of the oil, negotiated with them, but really gave them really poor deals, went in and just sort of took over the place, treated everyone poorly, gave unfair deals and all this kind of stuff. When they finally went into Iran, which was significantly later in time, what did Iran say to the, Exxon executives? Well, they came over, and the big rich oil dudes from Texas or whatever, they walk in, big loudmouth Americans, right? And what did the Iran delegation talk about? They're like, look, we're going to school you here. And they did, right? They're like, they talked for days, educating the oil men how they're not Arabs. So you're not going to treat them like Arabs. You're going to give them better deals than the Arabs and all this kind of stuff. And it was really interesting. It was just this big cultural thing that, you can imagine an oil man from Texas, 100 years ago, to him, Muslim is Muslim is Muslim is Muslim. And it was just funny. So they and Iran fought from some pretty hardcore deals right from the beginning because they saw how poorly the Middle East was treated, specifically like Saudi Arabia and the Gulf region, right? And they're like, you're not going to treat us that way. It was very interesting. Okay. See? Right in here. So there's that. We have to look at kitty cat too, right? Because we had the Canadian jobs report. And here comes the second chance. If you're going to do it, you need to think about it. Love will tear us apart again. Okay? So there's your second chance role reversal type trade. Cool. Hey, can you guys give the webinar a like? It'd be appreciated. You do that, it makes a difference, and it gives me feedback and stuff. It'll help out FX Street out. They're the ones hosting us. Super appreciated. Okay. Anyways, we're cruising in here. This is a very important area right here. Very, 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 very important. Shields up, red alert. Shields up, ready, red alert. This is a big deal. Here it comes. Big deal. Be careful. Love will tear us apart. Oh, super like. Thank Debista. Telling you, Debista, we need to meet up in Nepal. I'm waiting for that. Okay. Very interesting area. I don't know what it's going to do with all this news and counter news and fake news. Fake news. But this is a key area. You got to be very careful. And see, you wouldn't want to buy it here, and you might be looking at the opportunity for selling it. Okay? All it's piercing the 618. Be careful. Love will tear us apart. Okay? I don't want to look at it. It's too crazy. Okay? The next buy zone, by the way, let's say this doesn't work. It still fits the original plan. So this whole X is the buy zone. Okay? Standard swing trading, right? I think a lot of you have taken the swing trading course at FX Bootcamp. There's been requests that I host live swing trading events for weekly setups and monthly setups. I'm trying to do that. But I'd only do it for people that have taken the course. But if you've taken the course, you know this is pretty simple. Let me clarify though. I want to have this central pivot hold. So on this weekly basis, that's a buy. So like on Monday, you would have bought it in here, right? And I think last Friday, I recommended buying it in here. However, looking for here, I'm already thinking next week. So yes, this is decent support. This is better support. This is decent support. But if it went up now, it's actually next week's. This is Monday's mega support. Right? You see what I mean? You see what I mean? We're actually thinking about Monday. I'm barely looking at today's or this week's pivot. It's important to me because it is a buy, but it's a moderate. I'm already thinking Monday, Tuesday, Wednesday price action. So if it falls further, it's going to bum me out more than you would think. Because I'm thinking next week. Okay? Strange, right? If it does fall further, it may make me become a bear next week. But I don't want to do that yet because it's still at a perfect bull zone. And if I'm not the only trader on the planet that sees this, in particular an institutional, right? If other institutional investors don't recognize that as a buy, then it'll fall. It'll be fine. And then, I'll just rearrange my plans, which is fine. That's part of trade planning, right? But as is, it's perfect to go long. Now, I wouldn't blindly buy it, especially after non-farm payrolls where volatility is high. But now dropping into a small time frame, zippity-doo. What if I got a reversal pattern here? And by the way, what's this giant black line? I'll give you a hint. It was there before the news came out. Now we got this thin black line. What's the deal? This black line up top is the monthly central pivot. This thin black line, which we've respected once already, is the weekly central pivot. So anyways, I really don't want it to fall. I really don't, because it'll mess up my plan for next week. But being volatility, it'll do whatever it wants to do. Okay? So let's say it falls further. It's still a buy today, but then it changes my plan. So then next week would probably look like this instead. And that then consolidates the week after. So this kind of kills it until April. It'll go down a bit, and then it'll come back up and stuff. And you notice, so I'm thinking here weekly, but then down here I got a monthly, and then that's a double bottom. So really what it's saying, if it doesn't hold now, we could essentially see something like this for March. And then a rally in April, maybe? You see, like I have to go back and readjust. And I don't want to readjust because this, what we just looked at, is perfect. It's perfect. It's exactly what I would want if I'm a bull. Doesn't mean it'll happen. Okay? But if I'm a bull, that's exactly what I want. And anything lower, gosh darn it, it muddies the water. It's cork in my vintage bottle of wine. You're like, son of a gun. How about one? See, I'm not looking at price that way. How about 120? You want 120? What's the scenario of 120? Scenario of 120. All right. You're going to need, I don't think we're going to get down to 122 today. I don't. Okay? But let's say that's true. Let's say maybe we get to 122.50. That puts us sort of down here-ish. Okay? And then there's a bit of a rally between now and next week. And it's a false rally. And you're going to need the false rally because you need new blood in this. There's not enough bears quite yet. So you got to kind of pick up some more bears along the way. It's sort of like a road trip to Vegas, right? And you stop along the way to pick up some friends. You kind of need that. So that gets us down to here next week. So let's say down today, up Monday, down Tuesday, Wednesday, and Thursday or something, right? And then what? Are we at 22 yet? Or are we at 20 yet? No, we're only at 22. Now it's difficult, right? Why is it difficult? Because it's not enough. Because that just gets us to here. Let me draw this. That only gets us to here. And we run out of steam in a pivot profit zone at a double bottom. Dude, bears are going to take profit there because it's not certain. Which means then we got to pop back up and some consolidation, and then we need a breakout. And the only way I think we can get to 22 is to maybe double bottom today. Okay, sell off the monthly central on Monday at London Open and just have a serious, ridiculous wave of selling. But that only gets us to 121.50. Then you're going to need a retracement back up into the sell zone. But now we're talking Monday, 10 days from now. And then I guess down into, that still doesn't get me to 120. I mean, we're talking about 2 weeks, 2 full weeks. So 3 weeks from now, maybe 120. I'm not buying that quite yet, or in this case, selling it, right? I'm not into that yet. I don't think that was enough. I think the non-farm payrolls wasn't enough. Okay? So I'm not ready to go there. Whoever asked me. Brooke said that, right? Brooke said, well, what about 120? I just don't see it. At the moment, as they say in Paris. Right? So what I see now is that we are in a perfect buy zone for bullish swing traders. Right? And the line in the sand is 22.76. And we've been stuck here now for a while if you're counting minute charts. After dramatic price action, we've double bottomed at that one exact price. So once again, I'm not ready to change my mind. I'm open-minded to do it, but it's not something that I want. All right, who said that? Mohit says you buy it at 22. 22, 50, 20. Yeah. Yeah. Problem with that is, under current conditions, if it falls that far and it kills next week's bullish trade plan, then the top of the current market is R, which then predicts an S. And the S bottom is more like 21. So 22, if you're going to play the double bottom, but that puts us into a really mediocre month of March. So I get it. It's not as ideal. I think you're going to assume some risk that maybe you don't see. It's a 786. Yeah, so that makes sense to me. So if you buy it at the double bottom, you know what it tells me? We're going to consolidate. And that plays out technically as well. So I don't know. So it's like I said, you want to buy it at 22 and it's a psych level. There are pivots there. It's a double bottom. I get it. All of that is fine. It just doesn't mean bullish. What you'll end up doing is buying, and it'll probably go up. I think to some extent, Mohit, you'd be right. You probably pick up 50 or 75 pips. Yeah, probably. But then I think, based on what I see here, remember, I don't have opinions really. I'm just reading the notes on the music sheets. I didn't write Mozart. I can only play it. And if there's a note there, I'm going to hit the note. If it says C, I hit C. I don't know anything else, right? So I'm looking at this and like, if we go down to 22 and we double bottom and all that, yeah, it's a buy. And as a bull, you probably have to take it just because it's a double bottom, psych level, pivot point. But my assumption after that is it's going to really just consolidate. Boy, that's a long explanation, huh? 82 likes and 2 thumbs down. All right. All right. 2 thumbs down. That sucks, huh? All right. So why don't we do this now? What is Z time? What is Z time? I don't have my panorama. I don't have a watch. Okay, we'll have to go here. 9. We're about half an hour away from the stock market open. We are officially halfway done the webinar. Halfway done. Most webinars would be shut down by now, right? I will open up the floor to questions, just like I did. So someone said, "Well, what about 120 or what about 122?" All this kind of stuff. I mean, I thought you got a lot of information on such a basic question, but I think that's why you're here, right? So imagine we do this every single day at Trader's Way. Every day. So just open an account at Trader's Way. Hey, bro. Okay, questions coming in. Ooh, I want to sell the euro dollar at this level. Oh, okay. Well, if you want to sell it, Here's the thing. I just pointed out a ginormous level of support that I think maybe institutional buyers would be very interested in. And now you're asking me, should you sell it at this support? I don't like selling at support. So you're just going to have to totally disagree with me and just say, there's no support there. There's no central pivot point. This is not a buy zone for institutional investors. Sell. Yeah, so I see support. So if I were me, I couldn't sell it. But could you sell it? Yeah, I'm sure you could, right? So what would you do if you didn't see support? Now, I'm struggling with that part because I think it's so obvious. But let's say 23's up there. You know, even that's a 786, bro, which tells me double bottom here. I don't think I'm capable of doing it. Even when you ask me to tell you, I don't think I can. I only see buy. I mean, and the funny thing I was telling you here, I didn't see buy here or here or here or here. I only saw buy here. I only see buy. And I'm begging because it's not just today's buy, it's next week's buy. And then I expect, what, 200 something pips, 188 pips on this. So like, okay, if it failed around 123, I mean, we're at 93. I guess if you had to do it, if someone had a gun to your head, I guess sort of in here would be fine. You get the 618, you get the roll reversal, you get a 786 to protect you. Maybe you put your stop above here, so you're short at 90 and your stop is at 20. So a 30 pip stop, you could probably live with that, right? Right? If someone had a gun to your head? Yeah, okay. Yeah. Because I got to be open-minded. I mean, obviously I can be wrong, right? So, okay. Yeah, if you had to do that and you risk 30 pips and you don't see support, that's a lot, right? Then yeah, okay, sure. Yeah. Okay, do it. If that's what you feel. To me, it's not even whether one is right or one is wrong. Do you see the risk involved? Maybe just wait. Well, RCAT says this is selling here is suicide or just stupid. No, because ultimately we don't know. So how about this? Just for the sake of everyone. If you're a bear, you sell at resistance. And if you're a bull, you buy at support. Okay? Ideally, you're selling in downtrends and you're buying in uptrends. Those are the two pieces. Does this look like it's moving down? Yes. So is it okay to sell? Yes. So now you're going to need resistance. If you're a bear, you're going to need resistance. I see it a little bit higher, but there's a psych level, there, all this kind of stuff. So if you sold up high here, close to at least the psych level, and then you got some resistance here, and you got some price action resistance, you got market resistance, then why not? Okay? Why not? I'm not saying I would. In fact, I'm saying I wouldn't. But I'm asked about selling. So if you don't see the support and you only see the resistance because that's your bias, I am happy that you have a bias. And we never know who's right or wrong. But if you're trading in your bias, when you're right, you're going to make more money, and when you're wrong, you're going to lose a little bit. So you'll probably be profitable, and you could be a bear, and I could be a bull. And when I'm right, I'm going to make more money. And when I'm wrong, I'm going to lose a little bit. And I'll probably be profitable. And we disagree with each other on bias. But because we're good traders, we'll both be profitable. So if I was a bear and I did not recognize this as support, because why would I? I'm a bear. I'm like, if I'm confident we're going to blow through this, then this is weak support at best, and I'm going to sell the retracement, or I'm going to sell it high at the psych level. Okay, good, fine, good, boom. But I would rather have bought it low and held it all next week and make 188 pips or more. So it's not stupid, it's just fitting one person's bias over another. I'm more concerned with you trading your bias than being right or wrong. Okay? If your losses are small and your winners are big, you can have more losers than winners and still not lose money. Right? If your average loss was 33 and your average win was 99, you could lose 2/3 of the time. 2/3. You could lose 2/3 of the time and not lose any money. So now the key to success is not losing 2/3 of the time. Let's say you only lost half the time. You'd be profitable. And if you lost 33% of the time, which isn't totally achievable, right? Then you'd be quite profitable. So again, it's more like as long as you're trading your bias, you know whether you're buying at support or selling at resistance. And that should be, if you use technical analysis, pretty easy to identify. So if you only are a decent trader trading with a decent plan, then when you're wrong and you lose a little bit. What's the big deal? And when you're right, it's not that you were a genius. You sold at resistance in a downtrend. You're definitely not a genius. The market just happened to agree with you. Sweet. So you just have to be a good trader. That's all I'm saying. I'd rather you trade good. Because people is stupid, right? So to each his own. Okay. Going back to the CAD, I freaked out at this price here. Was it helpful? Come on, knuckles. Give me some knuckles. Was that helpful? I went ape crazy there for you. I did shields up, red alert. Here it comes. This is key. This is roll reversal. This is 618. Their bear's going to be sitting there freaking out. I hope that was helpful. Hey, who's going to give the 100th like? And look, 2 of the thumbs down went to a 1 thumb down. I earned some loyalty and respect. Thank you. That's super awesome. All of a sudden, there's going to be like 4,000 bad. But anyways, thank you. That's cool. There's always going to be haters, right? Because the haters going to hate. Yeah, see, I lost. There we go. Haters going to hate. Shake it off. Shake it off. Cool. Yeah, I can teach you how to be a successful Forex trader. That's my opinion. I honestly believe that. It will still take you blood, sweat, and tears for years. Sorry. All right. So one of the things we do at Trader's Way is this Mexican peso trade. We set this up days, if not weeks in advance. And I sold it and broke even. Broke even. One of these moves here, it rallied up. I think I sold this first one at like just below 1890. Or maybe at 1890. It fell, it rallied up, it came back down. I jammed my stop because it already got challenged once. Came down, jammed my stop, came up, took me out at break even, and down. Shake it off, shake it off, shake it off. Oh, I hate that, don't you? But here's the thing. And maybe another benefit for you becoming a client to Trader's Way. We set this up days and weeks in advance for a sell. Not a buy, a sell. No discussion of a buy. Impossible to buy it. So that's really too bad, so sad, right? Target, if we're lucky, 1822. I know it's only 800 pips. You probably, it's beneath you. You're like, I can't do that, Wayne. That's picking up pennies. I say, no, it's picking up peso. But anyways, so I was in it, and I covered my risk and didn't get the reward. Did anybody take that trade and stay in it? Any Trader's Way clients get that one? Where are my T-dubs? Was that Constantine just got his message rejected? Ooh. I wonder if anyone stayed in. Andre, oh, nice. Yeah. Yeah, stopped out. Yeah, me too. Me too. Take a look at gold. This line we have drawn here. It's interesting, right? Yeah, we drew it a week ago. Sarah Gold is in that peso trade, right on. Chris Wright says, what's my Euro USD target? I already pointed that out. It's up 188 pips. You have to be in it till probably Tuesday or Wednesday of next week. We'll probably hit that target. Okay? So anyways, gold down in here, it really is supposed to fall here. For some reason, I don't see it doing that, and I don't remember why. Oh, I know. All right, I'm being a smarty pants. I think it's because it's in the future buy zone. I think I'm being too clever on this one. So I'm going to skip that. I think I'm trying to be too clever. It feels too early to think this way. So I'm going to bail on that analysis. We're in a fib war on Aussie dollar, and I've advised people to ignore it. Oh, Andre says, thanks to me, he's profitable now in Forex. Double pump, huh? Double pump. Cool. I'll wait for those Cuban cigars you're going to send me, huh? Frank, the target for euro dollar, which I went through a great explanation earlier. I don't remember the price, but I know it was 188 pips from the line I showed you. So there's probably only 150 pips left. Okay. Okay. So anyways, going back to this is Aussie versus US dollar. And we're in a fib zone, which means bulls are buying it down here and bears are selling it up here. And it's really hard to know who's going to win this. So to trade it in here is sort of pointless and stupid. If we're above this area, if we get above, let's say, let me be conservative. If we're above 79, I'd probably start to look to buy dips. Oh, Andre, you took the summer course at FX Bootcamp? Cool. Yeah, some people said they took the swing trading course more than 6 months ago because it's so intensive. Even though their courses are expired, they're kind of freaking out. They're like, 6 months! I want to go back and learn it again, but it's expired. Come on, man. So I'm going to extend that so that you have a year. Okay? So what I'm talking about? So if you took the summer course last year, it'll expire this summer. So you'll get more time. Because apparently, even though you might have done it for 3 or 4 or 5 months, you want to go back and redo it again and find out where the rusty hinges are or something. So several people have asked for that, so I'll do that. So that's at fxbootcamp.com. All right. So anyways, fib wars, guys. And just to clarify, because maybe you don't see it. All right. See this big uptrend? I have a Fibonacci study on this, which means on this macro level, I am recognizing this bottom that's in play as a Fibonacci retracement. And that a bull would buy this down here. And if you buy a 618, you're expecting a 1382. Okay? You get it? A bull that bought a 618 is expecting a 1382, which is above our highest high here. It's so if you bought it at 77, you're expecting it to go to 83.5. Okay? You can see I have lines here indicating that it's a buy zone. I mean, literally. So let's go back to that other, like, let your winners run idea. Do you understand that you could have had trade plans buying this It's 77, even 77.50. And stayed in the trade. For, you know, let's say a 600 pip trade. I'm not confident that the majority of people in this room are setting up trades that are even possible for 600 pips. You might even blow your mind if you get 60 pips profit, right? You're like, I made 60 pips. Well, here's the thing, and we were kind of alluding to this earlier. You made 60 pips here, and you were so happy. You're like, I mean, at some point you need to have the bigger plan and the stronger bias to say, I'm in it to win it. I bought at a good level of support, and based on my long-term charts and my fundamental analysis, this has room to run. Not 60, not 75, not 100. Now, a lot of people bail just because they hit 100. Like, oh my God, 100 pips. It's worth more. Now, to be fair, I often bail around 333 pips because we know there's ebb and flow. So even though it's worth 600, I probably want to buy on the dips. But when my initial winner hits 333, I'll probably bail on it. But I probably have 2 or 3 more entries on the pullbacks. But and I'll keep buying the dips and letting it go up. But as they go up, take profit at 333. Why 333? I don't know. It's a magic number for me, where I find very often I could be up 333 pips. And if I don't take profit, somehow I get knocked out for 100 pips profit. And I'm like, if I always just took profit. So it's just me. You trade in great abundance. And every time you light up a cigar, you think of me. That's cool, man. This cigar and a box of them were bought by a client who I met actually in the FX Street Non-Farm Payrolls webinar. And then he sent me this letter and he's like, you changed my life, man. Everything is awesome. This is great. I just want to do this for you. And he picked out the exact cigar, which now I've been chewing on this one for a long time. But he picked it out based on a magical number in the price, and it had great meaning. And he just was saying thank you in such a deep spiritual way. So every time I hold this cigar, I think of him. It's cool. That might even be you, then I don't know if that is you. But anyways, I mean, just super cool. So awesome. I mean, look, it's a big part of why I do this. It matters, right? Yeah, it is Albert. Cool, Albert. Appreciate it though, but truly, it's cool. I do think of you. And I've been chewing on this one for a month and a half. It's been on my desk. I don't light it. I just keep it around. It matters. Things matter. And when you do find greater success from trading, you'll find that what matters to you will change. Right? And that's a cool thing. So anyways, I digress. This is the macro move. Okay? Now what? If the macro move is up, then that's cool, right? But let's go to a smaller time frame. This move, lower low, might predict a lower high. So when I'm trading technically, I look at roll reversals, and then above that, I look at the sweet spot. And let me use Kiss My Lips for that. I use this zone as my sweet spot. Okay? Long story short, while we're in this circle, I think bears have the opportunity to sell. It may not be a good opportunity, Because clearly if you sell here, you're not watching the higher time frame, but not everybody's right all the time, right? Not everybody does things properly. And markets will reverse. So whatever. But I don't know any more than anybody else if it's going to go up or down. I just know that buying there is stupid, in my humble opinion, right? And selling there is not as good as selling here or here. So, because one of the things they're looking at now, not only the role reversal, they're looking at down, up to the 618. Remember, this bottom is a 618 buy, macro. This micro move is a 618 sell. And that's why I call it Fib Wars. And this might actually, I don't know if I said it first or David Pegler said it first. But remember, I trained David Pegler. David Pegler is one of the best human beings you'll ever meet. He's also a fantastic currency trader. And he also does webinars on FX Street. Because I introduced him to FX Street through FX Bootcamp. But so I don't know if he said it first or me or somebody else. But it's a great name. There are people buying the fib and there are people selling the fib. We don't know which one's right, but if you can recognize the situations where that happens, you will avoid this mess that you see here. Another way I like to say it is, bulls buy down here at support, bears sell up high at resistance, and pigs trade in the middle. So if bulls buy and bears sell, what happens to pigs? What do pigs do? Well, how does one find the swing trading course? Walk says. It's on FX Bootcamp. Here, hang on. I'll get you a link. How do you get this swing trading course you speak of? All right, let me get you this. I'll put it back. It's been blocked because FX Bootcamp's not tied to, I think, to the FX Street channel. You'll just have to go to fxbootcamp.com. But anyways, yeah, pigs get slaughtered. Thank you, Frank. Yeah. Bulls buy, bears sell, pigs get slaughtered. Okay, so this goes to a great example here where if you were a bear, and remember someone said, can you sell up in here? I'm like, I'm okay with it. I wouldn't do it if I were me. But if you were a bear selling up high at this 123 is a great level. It's a psych level. There's stop up here to, pivot point up here to protect you. An old price action. If you sold up here, it's fine. I don't like it, but if you were a bear, that would be a great place to sell it. And, now they have a bearish engulfing candle and seems hopeful. Now, I feel hopeful because I hope, now, again, that doesn't mean it will go up, but I hope based on what I see in the near future, based on my plan for next week, I got to get that across. I'm already thinking about Monday and Tuesday and Wednesday. So when I see this, I know in the future this is a key price. It's an okay price here now, but next week it's an even more important price. That's cool, right? So I'm not saying it will go up. I'm not saying it will go down. But if it goes up from this price, no other price, just this one price. If it goes up from this price, it's super important. So it's more like praying, right? Hope is not a strategy, but praying never hurts. This is the one where you're like, oh my gosh, if this goes up, it's going to go up 188 pips from this bottom. Okay? And that's just simply swing trading. And if you don't know why I think that way, then you don't know how to swing trade. That's all. And if the bear sells there, yeah, it's fine. It's fine to sell there if you're a bear. Sure. It just muddies the water, like I said, and makes the next 2 or 3 weeks lame. So please don't do it. Hang on. Can't even cancel my or hang up my. I'm not running Skype, and yet Skype rings, right? I don't know what I do here. Can I even bring up a task manager? Maybe I kill it that way. Yeah, it's weird. I'm not even running Skype, and yet Skype rings. How do I just shut Skype off? Suppose I have to start it and then exit it. Lame. Microsoft is so lame. Let's see, sign out. All right. Do you trade gold? I love gold. You like the gold? I got the gold. We looked at gold already, but yeah. So what do you see here? I see mediocrity. I wouldn't buy it here. I wouldn't sell it here. Okay. I think you had an obvious sell. I think there's an obvious buy. It's supposed to be kind of like this, right? Maybe down in here, but I wouldn't do anything now at all. I think if you traded this now, you're a pig. Stock market has opened. The moving averages tell the same story. Yeah, they do, don't they? There's essentially, so here's what the person just said. You see this? Is the 2155 convincingly up or down? No. So what this tells me, looking at it zoomed in like this, is over this period of time, there's no market. There's only price. Okay. Say something, I'm giving up on you. I swallowed my pride. Yeah, look at that, huh? Boy, if you're a scalper, however, let's say you're just a scalper, then that's fine. What you see here is fine. You drop a stop, or you drop a lot, pop a stop, take a walk. But yeah, if you're a scalper, that where we are now is fine for a short. I like scalping. The only thing is you'll never get filthy stinking rich scalping. You'll work really hard and you'll make money, but it's income based. That's a fancy way of saying it's a full-time job. Income. Why do people go to work? Because you love your boss? Because their company is so great? That's gold. XAU. Okay. People go to work to earn money. And if you want to be wealthy, you don't work for money. You own the company that employs people that go to work for money. And let's say you pay them $100,000 a year per employee, but the average revenue generated per employee is $200,000 or $300,000 or $500,000. So everything left over just goes to you. So you sleep in till 10:30 in the morning because you're up watching Netflix all night because you have nothing else to do but drink wine and watch Netflix in your $1,000 massage chair. So then you sleep into 10:30 in the morning and you wake up and you're like, oh, I've already made $100,000 today. Whoa, good thing all those people are at my company working hard for me so I can live this lifestyle. A wealthy person doesn't have to get out of bed to make money because they make money whether they're working or not. They own. So in this case, scalping is like a job. It keeps you busy. It's a lot of work. You're going to be staring at your charts all day. And yeah, you'll win some of your trades. You'll lose some of your trades. And it's actually quite fun and exciting and stuff. But if you do it for years and years and years and years, after a while, it really is hard work, And it's stressful. It builds up. And you get unlucky a lot. And news ruins things or whatever. But you can do it all day, every day, But your winners, if you're scalping, what happens is you're 30 pip winners, 20 pip winners. Some people only scalp 10 pips at a time. I'm like, wow. They're not really worth a lot of money. So if you survive a long time, it means you're not taking on a lot of risk. And so these are lots of little winners. You better be very, very, very good, like winning percentage, for you to earn any kind of real money. But you don't want to leverage up your risk so that a trade is worth a lot of money because you can easily lose when scalping too. So you get to this point where you work really hard and you earn an income. Like, don't get me wrong. I mean, you make money. But since you keep paying yourself and you got to pay for your losers as well, it doesn't add up a lot to a lot relative to your initial account size. Okay. Now, if you let your winners run, and in certain times of the year, and I've showed this twice this year already, the end of last year and the beginning of this year, if you built up portfolios where you expect current market conditions to extend 3 or 4 months, this means you have a plan, you have analysis in play. And you don't just pick up 30 pips, but you expect pairs to move hundreds and hundreds and hundreds and hundreds, maybe 1,000 pips over the course of 3 or 4 months. And you're building portfolios around that analysis. So you buy a trade or buy a position, move the stop to break even. Buy another position, move the stop to break even. Buy a position, move the stop to break even. Buy a position, move the stop to break even. Buy a position, move, right? And sure, there are pullbacks and stuff and the ebb and flow, and sometimes some of your trades get knocked out, but then you just rebuild the portfolio and all that kind of stuff. But in those scenarios, when you get it right, a month, you could have 1,000 pips, 2,000 pips, 3,000 pips. Has anyone ever had a 10,000 pip month? If you build portfolios, you can. If you're scalping, there's no way. No way. So I've seen people, I've helped people reach their first 1,000 pip month many times. And it's like, it's an amazing feeling. Let me tell you, when you hit a 10,000 pip month, of course, it only happens in particular months through the year, not every year. But I mean, you got to have a lot of things go right, but you also have to put yourself in a position where you can. But think about it. If the yen pairs drop 1,000 pips each, right? One trade on each is 5,000 pips. But you know, you're not going to make the full 1,000 pips usually in a month. There have been times when you can make 1,000 pips in a month. But let's say like pound yen could move. But generally now it doesn't. But let's just say 300 pips average month for a, or even 400 pips, average month for one of the yen pairs. But if you had 3 trades on each of the yen pairs, that would come out to, let's say, 1,000 pips. But there are multiple yen pairs, right? I mean, it can do. It can happen. Now, Vinny says, what's the average, what are my average pips per month? That doesn't really matter because what I do is what I do and what you do is what you do, right? But here's the thing. Most people, or many people, let's say, would never even think of 1,000 pips a month. Often when I meet people, they're like, oh, you know, I'm going for 100 or 200 pips a month. And I'm like, okay, how's that going for you? To me, 200 pips is like one trade. Not all the time, not every trade, but you certainly, I mean, that's one trade for 1 week, right? If you know how to swing trade, my gosh, that's 1 weekly trade. So if you know how to like be in a little bit bigger trades, I mean, 200 pips for a whole month, like, it's nothing, right? So, but if you don't know, you don't know. If no one's ever shown you, you've never been shown. Maybe your guru coach that's been trading Forex for 2 years and drives a yellow Lamborghini on YouTube videos about how rich he is. Maybe he doesn't know, so you don't know. The point is, once you know how to set up better quality trades and have the fortitude through analysis and confidence to stay in the trade and set them up properly, you know, yeah, 200 pips is a decent swing trade. It's not even an amazing swing trade. So what you need now is 5 decent swing trades over the course of 4 or 5 weeks to get 1,000 pips. I mean, it's not that big of a deal, really. It's plausible. And like Roger Bannister breaking the 4-minute mile, it's never been done in the history of humanity. And it was a scientific fact at that time that the human body was not even capable. It was, right? It was medically or physically impossible to run a mile in under 4 minutes. Roger Bannister does it. 6 people do it within 6 months. The 150 years before or 200 years before, since they were even tracking this stuff, nobody did it. And it was a fact it couldn't be done. Suddenly it was done, boom, and everybody's doing it, right? It's sort of the same thing where you may just not even know, like, that's what you should be doing. And all of a sudden you're like, this is really good. I'm learning how to make 8 pips every time I make a trade. Well, that's income. That's income-based trading, but you'll never get wealthy. Okay? So I'm just saying, I think once you know, you'll have a breakthrough. And then, of course, as you know how to trade better, all right, then for sure. But you got to know. You just need to know. And that'll be a big part of the hurdle. Right? Here's oil, by the way. This is, and I think what we were talking about here is actually like a hope type trade. That's not the actual, okay. This is, it's flattening is what it's happening. I'd almost treat that as a sideways move. So we got to be careful. That's short-term neutral on that one. We can look at, let's do some yen. Okay. We're in a key spot here. Euro yen, if you're a bear, you're in a sell zone. And if you're a bull, your buy zone was down here at 130. Where are we now? 130, 150. Traders Way clients will tell you on the Friday we were here. So 2 Fridays ago. Let's see, 1, 2. These are daily, right? Yeah, daily. 1, 2, 3, 4, 5, 6, 7. Yeah, 8 trading days ago. We had this set as a possible buy. I cautioned everybody that nothing here says buy, except we're in a place where institutional investors would buy. We don't know if they, not that they would, that they could, they would be interested in buying, but we don't know if they will. And that we need to keep our eyes open. Now it's been, 8 days, 8 trading days, so it's been a week and a half. And the fall has certainly stopped, right? Couldn't you see that? Couldn't you set this up as a 1, 2, 3? Could you set this up now as like an inverse head and shoulders if you happen to already be a bull? So we were talking about it here, right? On the way down, not here, before it even found any evidence of support. But couldn't you treat this like that? So the question always is, the market was clearly bearish. When do you decide it's no longer bearish but has turned bullish? Okay. That's what we talked about 8 trading days ago for Traders Way clients. What do you think? Does it look like now that we've moved forward in time, does it look like it plausibly could be changing directions? And how would it make you feel if you opened up Kiwi yen, Aussie yen, pound yen, dollar yen, so on and so forth, and they're all exhibiting the same maybe buyers will buy? We don't know if they will, but at least the technical analysis says if there are buyers in the market, they would be thinking about this area. I think it would be influential, wouldn't it? Yeah, Joe says since he opened his first real account in January. Oh, so that's just a couple of months. Start to realize how important psychology is in trading. Yeah, and it's amazing. That's where planning kicks in. You're going to need solid plans and a solid bias to keep you confident. You're going to need, you have to rely on that. But also, imagine you're working with clients who want to invest into you. You better be confident, and you better be able to talk about your bias and your trade plan for the near future. Otherwise, you're gonna be unconvincing. No double bottom though, but there are other things going on here. Okay, on a 1 hour chart, there's an inverse head and shoulders in here almost. There's the higher high, higher low, 1, 2, 3 Fibonacci entry. This is clearly a buy. Now, let me share with you this one here. Not the bigger one, the smaller one. Okay. It's after the fact to talk about it now, but we were talking about looking for a pattern like that in here. And then, I don't know, 3 days goes by, and at the exact price, so we were looking at 130. If price holds up at 130 and then makes a higher high, what is the secret word in a scenario like that where we see a bottom and then a higher high? Let's see how many people here know the secret word. And this will be evidence that they know what the secret word means, they know how to set it up, and this is because they've been coming to Traders Way webinars for probably years. What is the secret word in that scenario? See, these are Traders Way clients. There's a secret word, a key word. And you're like, hammock. Yes, that is correct, hammock. Which means these people have been trained and know how to trade this and would have set this up for a buy. And that we had talked about it, it looks like maybe 2 days in advance. Then they saw the breakout, knew what to do, drew a Fibonacci study, and set up a trade to buy at the lower high, leftward looking, roll reversal. But all of that is so difficult to say that we just say hammock. And that they've been so well trained that it's like being trained in the Navy on a battleship, where the captain of the ship over and over and over and over and over and over and over again drills the sailors, so that while you're eating, battle stations, and you run. And while you're, I don't know, scrubbing the deck, battle stations, run, and you got to run and jump into the gun and get all ready to shoot. Oh, it's just a drill. and you're in the shower. Oh, run, battle stations, getting your gun, and you're there, right? No, it's just a drill. Over and over, dozens and dozens and hundreds of times, to the point where you're sleeping in your hammock, because this battleship's so old, you actually sleep in a hammock. You're sleeping, and battle stations. And you get out of your hammock, you put your boots on, you run down the hallway, you open the big steel door, you know those big heavy steel doors, and you duck your head, because right, and you climb up the ladder, and you sit in the gun, you're ready, but your eyes are shut, because you can do this in your sleep. You've been so well trained that you can jump out of your hammock, run to the to your battle station, duck your head so you don't hit your head on the top of the steel door. Climb the ladder, get in the gun, and you can do it in your sleep. Hammock is the key word, because I've trained people to be able to take a trade like that days in advance, setting it up, and they know how to do it in their sleep. They're good. They're that good. That's good. That's really good. It's a very nice. Cool, man, right? Swing on by. I'll be on Monday. I'll teach you. So it's 10, almost 10 o'clock. What are we going to do for the next 30 minutes? $115 people have liked this webinar. 3 people think it sucks. Yeah, so Vinny, it comes down to time of year, quality of year. Every year is slightly different. The way that I would rather answer it, because I just want to say, first of all, there are times in the year where you should be earning thousands of pips in a month. And there are other times when that ain't going to happen. That's part of seasonality. But what I'd rather you coach you on than pips, because pips are irrelevant, and lot size and all that kind of stuff. What we want to get you to, what I would recommend for you, is that you earn somewhere between 2% and 6% a month. How about just like 5% a month? Because over the course of a year with compounding, because every month your account will get a little bigger, but you still want to try for the 5%. And then the next month a little bigger, and another 5% of that number is now bigger, right? At the end of the year, you would have doubled your account. Okay? I'd rather you be focused on that. Number of pips and all of that is, for example, you could, I don't have it here, but like you could pick up 1,000 pips on Mexican peso and be a hero and not have enough money to buy yourself a latte. So, it's not really pips, and I don't mean cheating that way, like, yeah, I made 10,000 pips, but it was all in peso. No. I'm talking about having dozens of trades open, earning hundreds of pips each. Okay? And the point I was trying to get across is that I'm such a good trader and all that kind of stuff. My point is I had longer term plans based on fundamentals and longer term technicals. I set up trades one at a time, move the stop to break even so I have no risk, and adding to the position, adding a second trade, adding a third, adding 10, having 20, having 30 trades open, all at break even, because I'm catching trends and I'm letting them run. Okay. That's That's my point, and we don't need to dig any further. Cool. All right, gold taking a bid, huh? I swallowed my pride. Okay. Hey, look it. Was I saying up or was I saying down? Thanks, Vinny. Okay. Hey, Ron, that cigar gift card you sent me, I just ordered 2 boxes of Monte Cristo. I got a Monte Cristo white and a Monte Cristo something else. Now I had to combine and put money in and stuff. So you got a few of those cigars in there for me. So thank you for that. Cool. So anyways, I think at this point in regards to a stop, I would be considering moving my stop to break even now, assuming you're in fairly close to the line, right? Because remember, we were talking about it when we were actually wicking below my entry. So now that we're up in here, I think it'd be all right to jam that stop. Wholesale inventory 0.8. Great. John Evans, I think that's his name, right? Anyways, Evans, I think it's John Evans, isn't it? Evans, after NFP, said the job gains were very strong and it was very good news. Fundamentals are really good. Economy is very strong. Labor market is not leading to wage. Hang on. To wage pressures yet. Thank you, TradeTheNews.com, for that update. Porsche. So now what happens? I don't know. But I'm telling you, if, and this is what we talked about before the news, or before it moved here, if this breaks above, I would stay in it for the remainder of 188 pips. And my target is, I got to go to a 4-hour chart. My target is 124.69. Say something, I'm giving up on you. Forex Pipper says, this is a great business, but don't you think retail is threatened? All right, well, why don't you get good enough to go pro? Start a hedge fund. Everyone that gets squeezed out, they can send you money. But do I think they're going to get squeezed out? No. I think regulation is appropriate. I think protecting the client and such is appropriate. I think having rules of engagement and responsible levels of risk is important to the maturity of the economy, not the economy, of the market or the industry. And no, I think retail forex trading is legitimate, and I think traders have gotten very good over the years. But you still see dum-dums. Like when you do search on YouTube for forex, how much of it is like, you know, idiots promoting some rap star lifestyle? It's a lot. And I'm like, what the hell is this stuff? You know what the lifestyle is? Spending the weekend reviewing your trades from the week before. Spending the weekend on the back deck, drinking coffee, smoking a cigar, reading central bank reports. Right? Economic releases by the Reserve Bank of Australia, the Bank of Japan, the ECB, all in 1 week. Well, you got to print those out and read them, son. Right? That's the lifestyle. Leaving the barbecue Sunday night when all your buddies are drinking beer and stuff, and they're like, oh, this is great. And you're like, I got to go. What do you mean you got to go? It's only 4:30 in the afternoon. You're like, well, Asia's opening. I got to go. I have to plan my trades. I'm planning my week. And they're like, oh, come on, stay. And you're like, I appreciate it. The barbecue is great. But honestly, I got to go. And you go. That's the lifestyle. Yeah. If you want a yellow Lambo, buy yourself a yellow Lambo. But that seems like a childish thing to do, in my opinion. Right? I mean, there's one that popped up after one of my videos, and he's driving his yellow Lambo and stuff, and he's like, look at me, I'm the world's greatest trader. I got it right on my MT4 account he's got on his phone. I made like $1,000 today. Like, so what? You make $20,000 and you're driving a $300,000 Lamborghini? That's stupid. What an idiot. Sounds like poverty to me. You make $1,000 a day? That's it? And you drive a yellow Lamborghini? So silly. But whatever. I don't know what they must be selling something. I don't know what it is, but so ridiculous. So anyways, yeah, you gotta love being a currency trader, and you shouldn't be in it for getting rich quick. You should really like what you do. I've been doing this a long time now, and it's now at the point where I've been doing this longer than anything else I've been doing. I really like it. Oh no, I don't think he bought it, Joe. I think he leased it or rented it. So anyways. Okay. So anyways, whatever. Don't jump into this for the wrong reasons. Okay? This is a career. Okay? This is a career. Oh my gosh. What else is going on, guys? what can we dive into? We avoided fib wars here. Peso's falling like we set it up to do. Gold is starting to move. Fine. Look at this, guys. Look at it. Okay. I don't think I could have been any more clear on my point of view. So. Cool. So why don't we look at some exotics and then call it a day? Dollar weakening against the rand. Dollar weakening against the lira. Dollar weakening against the peso. Cool. Okay. Am I a bull or a bear on these pairs in the long run? What have I been coaching you? I've only been coaching one thing. Am I a bull on these pairs or a bear on these pairs? See you, Lester. Only one person knows? Yeah, bears. Cool. And I gave, I think, a half an hour discussion on why. So now I have to follow it up, like, where's the best entry on here? This is an easy target, may not have been easy to take. It was something you could have been in a week ago. Now you're feeling a lot more confident than you were earlier in the day. Peso, we set that up on the 1st of the month. So that's an easy one. So yeah. And you can see lira is the laggard here. But that's all right because I want to get into lira. So a couple of months ago, we sold the lira up here and did really well. And it's retraced all the way back, not being in it. I took profit on it. And now it'd be interesting if we could buy it back again. And I forget the, was it 500% annual interest rate? It's pretty good. Oh, you want to get to M4 on lira? So you bought it. Okay. Yeah, I know what you're saying. Okay, so your swing trade entry was M2, I'm assuming, and you were thinking M4. Yeah, there's nothing wrong with that logic because you're seeing it as an uptrend. Okay. The thing is, I'm fundamentally bearish, so I wouldn't see it that way. FX Piper or Pipper, sorry, FX or Forex Pipper says, do I play currency meters? Well, I think what you're talking about is relative strength. Yeah, we can do that. Oh, so Katrina says to buy now. Yeah, to buy, but you would have bought this again a week ago. You wouldn't be doing it now. And the reason for that is it failed to make a higher high, so it's dead to me. I either take profit or I jam my stop for my original buy, but I only see one opportunity to buy this, and it's way down here on the 6th of March. So I guess, I don't even know what the date is now. Is it the 9th? So yeah, it's probably Monday. I only see one opportunity, and I knew that on the 1st of March. So these, what are these, weekly pivots? M1, yeah, so they're weekly. So I knew that at the beginning of the month. So I guess you bought it, there's a buy on Tuesday, and that's it. So if you bought it on Tuesday and now it's Friday and it's tanking on you, I think I would have bailed on it already for profit. Would you buy it again now? See, it's hard for me to do it. It's sort of like the other one with the euro dollar one. It's hard for me to do it. So like I could say, okay, I guess so for next week's price, that looks fine if you're a swing trader. But I'm a bear, so I just don't see it. I can't get past the failure to make a double top. Okay? So, yeah, it's funny. So you missed it, I think, is basically right it. Oh, you want to sell. Oh, well, you said something about M4. Oh, I know what you're thinking. Oh, you think M4 is an entry. No, 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 no. Not really. Sometimes it looks that way, but no. No, 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 no. M4 is a target. So when you're talking about M4, I'm thinking you're a bull, not a bear. Now, often bearish moves start from the M4, but I wouldn't think you're a bear sitting around for a rally up to M4 and you want to sell a higher high. Bears don't sell higher highs. Okay, so if you're a bear now, okay, I get you. Let's say this finishes its move today. Okay, I think it'd be cool if you dump this around well, this whole area here on Monday. Okay, which is essentially the same price you're at now. Just I would expect a pullback first, but either way, you could just do it now. I mean, you should have done it a little higher. I mean, if you're a bear, you would have sold the double top, right? At resistance. So, so anyways, I think that's it. Okay, yeah. So no wonder. So yeah, again, if you say to me M4, I'm thinking you're a bull, because a bear wouldn't expect it to get to M4. If you're trading it as a bear at M4, you're not necessarily entering a trade, you're hunting stops. And it's a different mindset. It's more of like a scalp into a spot, and maybe your spot into a swing, but you're selling a higher high, and that's dangerous as a bear, okay? Sorry, I don't get enough sleep. So now what? What's left? What do we got to do? We got 15 minutes. Let's squeeze some blood from the stone. How do we maximize our next 15 minutes? Looks like 4 people think the webinar sucks. Thumbs down, they say. Really? I guess I come across as a jerk sometimes. That's plausible. So good music forever. We set this up as absolute, total, unbelievably clear as it could possibly get for a long, to the point where I couldn't even consider a short. Like, I couldn't even barely understand why you would short this. And I also said that I would be in it for the majority of next week with a target of 188 pips. The target now is even moving a bit. So as much as you can get, good music forever. Yeah, no Metallica this week, huh? Yeah, I didn't even do any jazz music and stuff. Oh, good question. Forex Pipper says, why do you play lira versus dollar? The carry is versus euro is higher. Yeah, I'm a bull in the euro. I'm a bull on euro. I'm a bear on the dollar. So you're right, except I don't want to sell euro. I've been a bull in the euro for quite some time now. Like months and months and months, maybe years. I can't remember. So anyways, that's why. Good question though. You're totally right. There's a higher carry. The swap's higher on euro. I'd do anything for you. So, is anyone going to sign up for at least a demo account at Trader's Way, so that I'll see you in our webinar on Monday? Monday morning, 7:30 in the morning, New York time, approximately London lunch. 2 hours before the New York session opens, we can get together as a community and we can look at the new pivot points and set up the week and go through the calendar. Euro dollar target is right here. It's right there on the chart. So right now it just moved a little bit, 124.84. Let's just try to get it to 125, okay? Oh, excuse me. Uh-oh, another sneeze. Uh-oh. So only 200 pips is what I'm trying to say. Cool. So we got a few people opening up new accounts at Trader's Way. That's cool. Appreciate it. And then I'll see you on Monday. That's cool. Yeah, check out the demo, all that kind of stuff. Makes sense, right? Oh, you want to do, thank you. Do you want to know Beast? All right, let's do Beast. What do you think? Do you prefer this chart? I swallowed my pride. I'll do anything for you, but I'm saying goodbye. Yeah, so I think it would roll over if you're a bear, or if you're a bull, at what point do you decide the market's gone from bearish to bullish? And you say, well, Wayne, what is this? This is not your 2155. So, all you need to decide is this going down or is this going up? Oh, Frank, you're so funny. What's the link for tradersway.com? Try www.tradersway.com. So at what point do you decide? Well, I would have to think that you got to get at least above these two lower lines here, and then maybe catch a snapback, right? The little riskier trade is this up here through this stuff and then buy off there. But with NFP and stuff, I don't think that's prudent. But now if it goes to the green area and then back down to the blue area and the blue area act as support, I think I would long that. Okay. Something like that. Now going to a standard chart, what we're missing here are pivot points. I swallowed my pride. I'll do anything for you. All right. With that being said, on Beast, what do we see here? We started low, but it quickly rallied back up. So you need to decide if that's an M2 or not. And if it is, it is rising from a low of 145 to a high of 157, basically. 1,200 pips. And someone's going to be happy with 200. And I'm like, why can't you make 1,000 pips a month? That's one trade. Why can't you make 200 pips a month? It's one trade. Have one trade plan versus scalp, 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 scalp. Put together one trade plan. Suddenly you're like, 200 pips a month is embarrassing. My coffee is nearly empty, or actually is empty. So I think that means we're done. Yep, we're done. So thank you to FX Street for hosting me for the this webinar for the 143rd time. Next month will be our 12-year anniversary. On behalf of TradersWay.com, I'd like to say that we love you. We care about you. You're our sweet baby. We hope you come to TradersWay.com, open an account. Let us earn your loyalty and respect. And clients have access to me every single trading day. So on Monday, we'll do another webinar like this. It lasts an hour or so, usually more than an hour. So that's cool. If you're interested in like the swing trading course or the scalping course or the fundamentals course, all of that is available at fxbootcamp.com. And that's that. That's it. I had a wonderful time. I hope you did too. Please leave a like. It's appreciated. You're appreciated. I hope you fall in love with being a currency trader. Oop. Come on, all these text messages. Hope you fall in love with being a currency trader. Yes, there was good music forever. Yes, absolutely, totally, unbelievably clear what my opinions were. Yeah, thank you, FX Street Moderator. There's no moderator like FX Street Moderator, like no moderator I know. I don't know, that was a bad song, but we appreciate you. Great moderator. That moderating was not moderate. That was extreme moderating. So peace on earth, may the pips be with you, may your profits be above average. Ending stream now. Bloop. Bloop. See you Monday.